we're going to have an inflation rate that is probably in the vicinity of 5%-ish. But it's a very uncertain inflation rate because of all the shocks that we have around it. But let's say 4.5%, 5% is probably what it settles down at after this tightening. At the real rate, in other words, the rate above inflation that the interest rate is now at, is in the vicinity of 1.5%, a little bit higher than that.
Economic doomsaying is widespread lately as experts and business leaders predict that record inflation could help set off a recession. Billionaire investor and Bridgewater hedge fund founder Ray Dalio recently added his voice to the mix, saying that there's nothing more federal regulators can do to avert an economic downturn and that stagflation is likely. In doing so, Dalio joined the chorus of critics who argue that the Federal Reserve has acted either too slowly or too aggressively with regard to inflation. The general idea that tight federal monetary policy can solve inflation is off the mark, according to Dalio. I believe this is both naive and inconsistent with how the economic machine works, he said. That's because that view only focuses on inflation as the problem and it sees Fed tightening as a low-cost action that will make things better when inflation goes away, but it's not like that. Even if interest rate hikes help to reduce inflation, the policies still hurt consumers by cutting into their spending power. Dalio doesn't see a future in which the Fed achieves a soft landing for the economy or avoids a recession while reining in inflation. There isn't anything that the Fed can do to fight inflation without creating economic weakness. Over the long run, the Fed will most likely chart a middle course that will take the form of stagflation. Stagflation is a combination of economic stagnation, high inflation, and high unemployment. It last occurred in the 1970s, when energy prices increased due to oil embargoes and combined with other macroeconomic pressures. Dalio, however, points out that tight monetary policy came with a cost. Inflation only went down with increased unemployment. In other words, inflation was reduced by people and companies being painfully squeezed and reducing spending, he said. That's always the case and will be the case this time. Let us now get into the video and hear what Ray Dalio has to say about the present economic situation and how terrifying 2023 would be if things keep on this way. Remember to like the video, subscribe, and drop your comments below.
What is the level that the inflation rate will settle at? Then how much higher do bond yields have to be? And then what will short rates be relative to those? So just to give you the quick answer, I think, we're going to have an inflation rate that is probably in the vicinity of 5%-ish. But it's a very uncertain inflation rate because of all the shocks that we have around it. But let's say 4.5%, 5% is probably what it settles down at after this tightening. At the real rate, in other words, the rate above inflation that the interest rate is now at, is in the vicinity of 1.5%, a little bit higher than that. So that would mean that there would be probably approaching a 6% risk-free rate, and the Federal Reserve will put the short-term rate up toward that level. That level of interest rate is very harmful, very damaging to the economy, but what the Federal Reserve is trying to do is balance those, having an interest rate that's high enough for the creditor, but not so high for the debtor. And so I think what you're going to see is a slowing of the pace of the rise, but an approaching, let's say, over 5%, probably in the vicinity of 5.5%. And that'll have an effect on all markets. It'll have a negative effect on stocks, right, because it has, of course, as interest rates go up, they compete, and then there are the challenges. And of course, that interest rate is the government rate. If you have low-grade credit, you can add 5 percentage points to that. So you're talking about a 10, 11%, which will have a very severe negative effect, particularly on companies that have relied on receiving funding on an ongoing basis. In other words, they don't have enough profits to carry themselves. What's priced in the markets is that there will be a sharp fall in inflation rates. We do know that there will be a fall in inflation rates as some of the exogenous factors like the oil price won't stay up at where it is and such things, some commodity prices. We're seeing that already. We're seeing that in housing prices and so on. So that'll bring it down some, but that brings it down from numbers that are in the vicinity of 8% to something that's lower than that and not sustaining. The wage sector, the employment sector, is going along relatively well because unemployment rate is low, so there's still demand, and the inflation that we're seeing is also coming from compensation inflation. So we're going to see those rates have to rise. So you see that built into the curve is a fall off in rates and a fall off of inflation. And I believe that you'll see it staying higher than those levels that are built into the rate. You know, there's so many demands on money.
Ray Dalio sees the classic early warning signs of a recession in the United States and expects the economic picture to get worse over the next 2 years. I think it's going to get worse into 23 and 24, which has implications for elections, Dalio said. He pointed to key red flags, namely drawdowns in cash balances that had been built up earlier, the contraction of both the housing and automotive sectors, as well as a rise in credit delinquency rates. We are right now very close to a 0% growth, Dalio said. The central bank, led by Chairman Jerome Powell, has remained consistent in its messaging that the Fed prioritizes reining in inflation back down toward its 2% target over economic growth. Dalio said the Fed has a trade-off between strengthening the economy and controlling inflation. They will tighten monetary policy and take away credit until the economic pain is greater than the inflation pain.
But we need money for poverty alleviation, building infrastructure, repairing the Ukraine, spending money for climate change. No longer do we have a mentality like an individual might have. They might say, how much money do we have and what should we spend it on? The big difference between individuals and governments is the governments don't have that constraint because they can print money. So I think we have this trade-off. Whenever in history you have a lot of debt and a lot of financial assets, it becomes very, very difficult for those to be balanced. And we're now in a shift. The prior decade, we had falling interest rates, which were goods for holders of bonds. Cash was very cheap, free almost. And so the whole investment landscape was very much built around that. Now we're having this adjustment away from that. So central banks try to balance growth and inflation. And so it will be a difficult balance, which creates an environment of stagflation, I'm afraid. Over the long run, look at your returns relative to inflation, whichever country you're in, whichever currency you're denominated in, look at the returns relative to inflation. Too many people look at just the level of returns and they don't pay enough attention to inflation. Generally stay away from debt-denominated assets. Third, have a well-diversified portfolio. Diversification reduces risk without reducing expected returns if you do it well. Also, don't be too tactical. I think you have to realize that the markets are a zero-sum game. And to compete in the markets is more difficult than competing in the Olympics because there are more people trying to do it and taking money away from others. So have a strategy which is over a long period of time, to save money in a diversified portfolio of assets. So those would be the most important things, I think.
Ray Dalio advises that investors and anybody with the intention of getting out of this mess unscathed should do well to diversify their portfolios. By diversification, you lower your risk without reducing your expected returns when done well. He also advised that you should always look at your returns relative to inflation. What makes up your best portfolio? You can leave a comment and help others make good investment choices, and always remember to do your own research. Please like the video, subscribe, and turn on notifications. Thanks for watching.